Hello and welcome to this week's instalment of Nucleus Investment Insights. This week we revisit the idea of modern monetary theory, or MMT, in the frame of the rampant monetary expansion, or in other words, printing, that central banks have been licensed to do in an effort to support economies during the coronavirus pandemic. Modern monetary theory is an unorthodox but popular macroeconomic theory that describes currency as a public monopoly. Issues like unemployment are caused by scarce currency supply, restricting the availability of the financial assets needed to pay taxes and satisfy savings desires. Generating more of it at a fiscal or government level will then create employment and stimulate demand, effectively meaning a government can finance any budget deficit by de facto monetisation and hence have no monetary limits. The commonly held belief that the use of MMT is a quick road to rampant inflation, with countries like Argentina and Zimbabwe often cited, has now been countered with the fact that more developed countries have employed huge monetary expansion, supporting individuals, companies and government budgets with seemingly little inflationary pressure. So the question remains, is the 2020 central bank stimulus essentially modern monetary theory by another name? Here to help answer the question, we have special guest and friend of the show, Dr. Stephen Hale. Dr. Hale is a lecturer at the School of Economics at the University of Adelaide, one of Australia's leading voices on modern monetary theory, and also author of the book Economics for Sustainable Prosperity. Dr. Stephen Hale, welcome back to Nucleus Investment Insights.
Thanks very much for having me, and hello Tim and Damien.
Great to have you on. And here to share his thoughts and also explore more about MMT and how these themes can be used in our portfolios, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Tim.
Hello. And now, just a quick reminder before we get started to subscribe on YouTube and to click the notification bell to be notified of when we go live or have a new webinar to watch, or of course follow us on your preferred podcast platform. We also ask if you could take a moment to click like on the video now to help our show grow. And of course, for those listening in live now, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. So I'll jump into the agenda. It's not so much an agenda, but a series of talking points today, just sort of highlighting some key areas that we wanted to chat about. We'll of course kick off with a brief background to MMT from Dr. Hale. We're looking at MMT and inflation expectations, so having a bit of a look at countries that may be closest to considering modern monetary theory, whether or not the US can run hot economically without modern monetary theory, having some thoughts around government responsibility and trust to be able to implement it correctly, and then of course finally rolling into our investment implications and thoughts on how these themes can impact the portfolios here at Nucleus Wealth. So I might hand over to Dr. Stephen Hale, if you wouldn't mind perhaps kicking us off with a bit of background for those that perhaps aren't as fully versed in MMT as you are.
Thanks very much. Yeah, I'm happy to. If I can start by asking everybody to, first of all, have an open mind. And secondly, I just wanted to say modern monetary theory has nothing whatsoever to do with printing money, and it's nothing to do with the monetization of government debt. These are common misconceptions, and if we can just get them out of the way, first of all, then I'll just say in the next few minutes what modern monetary theory actually is. It's just a brand name for an approach to thinking about how the monetary system works, which has implications for thinking about fiscal policy and the role of the federal government in our economy generally.
Okay.
The most important difference between MMT and the old paradigm, or what you might regard as mainstream macroeconomics, is that we take the monetary system seriously, and we don't think the traditional approach to macroeconomics, which has been dominant over the last 40 years, really has done that. I don't want to criticize neoclassical macroeconomics here. If you want to have a podcast to do that, you'd probably be better off getting Steve Keen back on than me. He's the expert as far as that's concerned. But MMT views the economy as a set of interlocking balance sheets, um, evolving over time, always with the potential to evolve in ways which might lead to a more fragile financial system and might be unsustainable. And the most important thing that we think the old mainstream approach to macroeconomics ignores is the distinction between a currency issuer and currency users in our monetary system, and the ways in which their balance sheets interact over time. So you and I are obviously currency users. Before we can spend dollars, we have to find them from somewhere. We've either got to earn them, or they've got to come out of our past savings, or we've got to borrow them. But if we borrow dollars now, of course, in the future, we're going to have a burden of debt that we have to repay. That has implications for our behavior in the future. And we could even end up getting into financial distress and being insolvent. But the federal government, the Commonwealth government, is not a currency user. It's a currency issuer. It doesn't have to go and find dollars before it spends them. Instead, every dollar it spends is a new dollar in our monetary system. This is literally true. Every measure of the money supply in Australia increases by $1 every time the federal government spends $1. So if you're talking about printing money, and you mean by that the electronic issuance of currency, this is something that the Australian Commonwealth government does every single day. Prior to the pandemic, they were spending about $1.5 trillion. No, that's not right. They're spending about $1.5 billion every day. And every one of those dollars was a new dollar. It was a dollar being credited to the reserve balances of our private banks at the RBA, and indirectly to the bank accounts of people within the private sector that the government was transferring funds to, whether they were employing people or buying goods and services or making welfare payments, for that matter. So the government spends dollars into the system. Once those dollars are in the system, they're available to pay taxes, or for that matter, to buy government bonds. Taxes are not necessary in order to fund Commonwealth government spending. They are necessary to prevent Commonwealth government spending being inflationary and eventually hyperinflationary. The taxes play a number of roles within our system at the federal level, but the most important role they play is to limit the ability of the private sector to spend, to create room within the productive capacity of our economy for the government to spend, to avoid government spending being inflationary. And of course, at least in the last 38 years, the government has had the habit of, when it spends more than it taxes, in other words, when it runs what we call a deficit, putting more dollars into the monetary system that it takes out of the monetary system, it's developed the practice since 1982 of approximately, anyway, auctioning Treasury securities, selling Treasury bonds and Treasury notes to take the additional dollars that is put into the banking system back out of the banking system again, to withdraw those dollars from the monetary system in order to prevent the banks having excess reserves of cash, which would mean that because banks had excess reserves of cash, there wouldn't be banks that were short of exchange settlement funds needing to borrow on the overnight market, and the Reserve Bank would lose control of the cash rate, which would fall below its target. That was the reason for issuing Treasury bonds to match deficit spending that was given by the Reserve Bank in 1982, when this practice was introduced. Prior to that, although Treasury bonds were issued, if there wasn't sufficient demand out there in the market for those Treasury bonds at what was the Reserve Bank's preferred yield for them, then actually the RBA supplied the funds directly to the government and just held on to those bonds. Once interest rates were deregulated in Australia in the early 1980s, we moved to the current system. Of course, a lot of the logic for the current system disappeared in March this year, when the RBA started doing quantitative easing and putting excess funds back into the banking system again. But I'm going slightly off the point there, just to start off by saying, taxes do not literally fund your spending if you are a currency issuer. Every dollar you spend is a new dollar. You then tax some of those dollars back out of the system. If you spend more than you tax, you're running a deficit. You're not going to run out of dollars, however, you're the currency issuer. And why does the government issue Treasury Securities? It's not because it needs to borrow dollars in order to allow itself to spend. It's the currency issuer. The reason for issuing Treasury bonds, well, there are a number of those, but the one that I've just given was to withdraw reserves from the banking system to keep control over interest rates. Now, our government is a special type, and we're getting to the important point now. Our government is a special type of currency issuer. It is a full monetary sovereign. To be a full monetary sovereign, three things have to be true about a government. You have to issue a currency, and you have to collect taxes in that currency in order, as I was just saying, to maintain the value of that currency and avoid your spending being inflationary. Secondly, you have to not guarantee to convert that currency into any commodity or any foreign currency at a fixed rate. In other words, you have to have a floating exchange rate. You have to have a genuinely fiat currency, which we've had in Australia since 1983. And thirdly, and this is important as well, the government has to have no significant foreign currency debt. If you have foreign currency debt, then you've got financial liabilities that are denominated in a currency that you don't issue, and you're not a full monetary sovereign. So if you issue your own currency, if you have a floating exchange rate, and you have no foreign currency denominated liabilities that are significant anyway, you're a full monetary sovereign. So if you are a full monetary sovereign, then when you are doing your budgeting, you face real resource constraints, because in our economy, as in every other economy, there is a limited supply of labor and skills and capital equipment and technology and natural resources and institutional capacity. And if total government and private sector spending goes beyond the productive capacity of their economy, it's inflationary. So you face an inflation constraint or a real constraint. You do not face any purely financial constraint. It is literally impossible for the Australian Commonwealth Government ever to run out of Australian dollars. It is literally impossible for there to ever to be a financial crisis relating to Australian Commonwealth Government debt, given the way that our monetary system currently works. So you have real constraints, you have no purely financial constraint, and what we sometimes describe as the third axiom of modern monetary theory. If you run a surplus, if the government runs a surplus, as the Howard government did for a few years, and as successive governments have been trying to do in Australia since the global financial crisis, and they thought they were on the brink of doing last year, what you are doing is you are driving the non-government part of our monetary system, if we ignore the rest of the world for the moment, the private sector, into deficit. A government surplus is a private sector deficit. If the government spends more than it taxes, they're making a net contribution of dollars to our monetary system. If they tax more than they spend, they're taking dollars out of our monetary system and weakening private sector balance sheets. So government surplus is a private deficit. On the other hand, a government deficit is a private sector surplus. So when people worry about the very high level of fiscal deficit that there's going to be this year, probably in excess of 10% of GDP, they can be a little bit more relaxed about it, actually, because it's better to think of that as a private sector surplus, as the government supporting the economy when it's not going to be inflationary to do so, and indeed it was essential to do so. And we can actually see that in the news in the last day or two. There have been a number of articles about the massive increase in private sector saving this year. The private sector is running a huge financial surplus, and there are a lot of households that are going to be in a stronger financial position after the pandemic than they were before, as far as their balance sheets were concerned. How has this been possible? Well, a lot of people have been fortunate enough to keep their jobs, have kept their incomes, but for much of the last year, they haven't been able to spend as much as they would have been able to before. So they've been saving, their balance sheets have been getting stronger. Well, what's helped to support incomes in general and to keep, we haven't seen overall personal disposable incomes falling in Australia this year. They've been rising a bit. What's made that possible? The government's deficit spending. Once you understand these things, it gives you a different perspective for thinking about the appropriate role of the government in the economy. You don't start to panic about the high deficit spending this year. You see that actually as essential. We would have had a catastrophic situation if they hadn't engaged in that deficit spending. It's actually going to strengthen a lot of private sector balance sheets. Sure, what people sometimes call the national debt, the government's debt is going to increase over time, and they'll have a net debt of $1 trillion before very long. But all the government's debt is dollars that they've spent into our monetary system and not yet taxed back out of the system again. It's no more or less than that. It's not a debt that they ever actually have to repay in the future. It's not a burden on future generations of taxpayers. That's the wrong way of thinking about it. I like to think about it as our net money supply. It's dollars that are in our monetary system, which the private sector has not had to borrow into existence because the government has spent them into existence. That's rather a long introduction.
Yeah, that's great.
Thanks, and actually, Stephen, I mean, one of the things which I think probably gets missed a lot is that the productivity of that spending is still important. I guess what in the end what we're talking about is saying, you spoke about having scarce resources of human capital and these other factors. If you go out and say, right, as part of this money, everyone's getting a free whatever for doing nothing, that's less productive than saying, okay, we've got these assets we can build, which will actually create either more demand or improve or lower costs for everyone, or improve the actual capacity of the economy by producing energy cheaper or whatever it is. So I guess what I'm saying is, I guess what I'm coming to is, you need to separate those decisions, don't you, into saying what are the actual decisions made? Is it productive or non-productive? And the second part is how is it going to be funded, and that how it's going to be funded shouldn't affect the your opinion about whether this was a successful. Does that make sense?
It absolutely does. Yeah. The only point I would add is that there hasn't really. It's not really the right way to look at what's happened this year to call it a stimulus. It's not been a stimulus in that we've not been trying to overinflate a balloon which has been on the brink of bursting. There's been a balloon which has been deflating rapidly. And we've been pumping extra air in to stop the balloon from collapsing. So it's been a support package. There's no likelihood at any point in the foreseeable future of this deficit spending being significantly inflationary. There is a potential upside from it, which is that some people are going to emerge from this crisis with less debt than they had before. Other people are going to emerge with more saving than they had before. And given that we have the world's second highest level of household debt relative to GDP, and given that if you go on the RBA site and look at their chart pack, household saving in recent years has been collapsing almost down to, in net terms, zero, which is where it was just before the global financial crisis. The temporary, very large jump in household saving this year is actually going to mean that a lot of people have got healthier balance sheets. And that in itself is a productive thing to have done, supporting people's incomes, and of course, keeping a lot of people only temporarily, I'm afraid, in some cases, because of the reversal of it, out of poverty by having significantly increased what used to be called New Start, the job seekers payment. It hasn't been inflationary. It's had lots of positive effects. But you're right. As we look into the future and as the economy recovers, it would be wrong to think that there was any good reason, given that there's no significantly inflationary episode expected on the horizon, it would be wrong to try to push the government budget back towards surplus when that's not necessary. But that's where, with the longer term investments, yes, we should be making those investments which are necessary to enhance our productive capacity in the future. And that's not just about economic growth, because we can't have a sort of blind growth at any costs view of the world in the future. It has to also be about making what is going to be an essential, it's going to be forced on us by the climate and also by the rest of the world in the next few years. We have to make a more rapid transition towards renewables and a more ecologically sustainable economy generally.
So I think there's a rabbit hole there we could disappear down for a while. I don't want to disagree with. I definitely don't disagree with any of that. But let's sort of put to the side where it's going. I guess I have a concern about the. I don't have a concern about the dollar amount that's being spent in the Australian budget. I guess what I have a concern about is the where it's being positioned, in that a lot of it's to support capital expenditure for companies. And companies have got plenty of spare capacity at the moment. They don't need the and if
absolutely agreed.
If they do spend capital expenditure, they're probably going to be buying equipment to fire people and and reduce their costs that way. And so I guess what I'm saying is I think part of the reason why it's not inflationary is it's pointed in the wrong direction, and a lot of that money's going to go offshore anyway. If anyone who spends money on capital expenditure, we don't manufacture very much here, so you're basically helping to support China, Japan, the US, wherever they're making robots and trucks and cars and capital goods. Yeah. So
I agree with you entirely as far as that's concerned. If it was, I mean, I'm quite upfront about it. I don't mind admitting where I am in the political spectrum. I'm a green lefty.
Yep.
And I think that we have become scared of, and it's not just green lefties that think this. There are very influential economists like Mariana Mazzucato that would say this. We have become scared of public investment, or of people talk about picking winners. I prefer to think about influencing the future direction of our economy and engaging in nation building investments. And I think that in partnership between the public and private sector, some of this can be done through the private sector, some of it could be done directly by federal and state governments themselves. The next few years should be an opportunity, if we either have the available real resources, and I'm thinking about spare capacity in relevant businesses and people with the appropriate skills and materials, or can create them. We should be ramping up our investments in a much more rapid transition away from fossil fuels as far as electricity is concerned, an increasing shift towards electricity as far as our power system is concerned. And there are, it's about time that we think about fast rail between Sydney and Melbourne, for example. Things like that should be back on the table.
Yeah, well, let's step away from, I guess, specifics and go. And
but I'm just saying I agree with you, really.
Yeah, and I guess where I'm coming from that, there's the next one is saying, and I think it's we've got a commenter on YouTube sort of chasing into this, I think in a different way, is saying, well, if we go and spend a lot of money into trying to say keep house prices higher for people who own it, or existing assets, how do we keep existing assets sort of at current levels? I guess I'm putting that into the unproductive side, which probably is a little bit inflationary, but it's not good inflation. It's just inflation from trying to bid asset prices higher, as opposed to inflation that comes because people have jobs and their wages are rising, and so because wages are rising and we've got full employment, that sort of starts to tick over.
Absolutely, I absolutely agree with you about that. I think that why did we get out of the habit of making investments in public housing in Australia?
Well,
and
Victorian
why
government's busy in that
sorry.
area. Yeah. Sorry, I'm certainly with you on public housing as being, yes. I think that's certainly some low-level hanging fruit, and obviously the Victorian government's decided to step in, and so it'll be interesting to see whether we get some economic data coming out of that over the next little while that hopefully supports those views.
Even that social housing, I think, largely, which is not public housing, it's not quite the same thing. But yes, I agree with you. We really need to think about what we value in Australia in the years to come, whether we have the real resources in order to construct what we value. And you're right, just throwing resources at investments by businesses which are operating at 2/3 or 70% of capacity at the moment, don't need to make capital investments anyway. Capital utilization in Australia, this is another reason that people shouldn't be so concerned about a potential big inflationary breakout. There's no upward pressure on wages. Actually, it would be good if inflation moved towards more normal times. We need upward pressure on wages for that to happen. So we need to be close to full employment. And there are other things that need to happen as well.
And it is a bit chicken and egg, though, isn't it? Because the government came out just recently saying, no, we're going to cap a whole bunch, 250,000 public servants will only get 1% pay rises because we can't afford it. And the RBA even came out, I think, last year or the year before, talking about how they were capping their own internal staff's one, and they're saying both of you guys are saying we need wage inflation. You should start at home and get some wage inflation from governments, at least, if you can't get it from retail.
None of this is directly down to MMT, of course, but I agree with you 100%. With that, you were going to ask me about inflation and inflationary expectations and the Fiscal curve, I think.
Yeah, I did, and that was it. Yeah, I guess I'm slowly meandering through it, but actually, maybe I could just start with the whole. So, since the crisis has started, we've got this interest in. I mean, one of the big issues with MMT is that, from an investor perspective, is saying, well, we can see what will happen if this takes hold, and it's a very different environment to what we've been in for the last 20 or 30 years. We're just trying to work out how likely it is to come, and so I guess there's certainly been since the crisis started, there's been a lot of money spent by governments. How much more acceptance, I guess, do you think you're seeing, and in terms of sort of from official sources of MMT, and how much pushback, I guess, are you getting as well?
Well, first thing I'd like to say about that is that Australia has had, modern monetary theory is just a description of the monetary system. So it's either, in some ways, it's bound to be oversimplistic, like any theoretical approach to a complex system is, but it's either largely correct or largely incorrect. I think it's largely correct, and although there have obviously been a lot of pushback as far as MMT is concerned, some of that has not been awfully well informed, because it's been attacking something which modern monetary theory isn't. Modern monetary theory is a description of how our monetary system works. And I haven't seen any criticisms of modern monetary theory which have been based on any facts within it, anything that we say are facts within it, being inaccurate. So we have MMT already. If people think, isn't this going to give politicians a lot of power and they're irresponsible? All we're saying is they already have that power, and they've always had it. We've had Our government has been a monetary sovereign government, a full monetary sovereign government since the 1980s. Are we going to introduce modern monetary theory? It's here already. We already have modern monetary theory. It's just a matter of whether we understand it or not. And
Well,
I don't see anything. I don't see any good reason for misrepresenting the monetary system, because you don't trust politicians. You may as well understand the system and then think about how you're going to constrain political behaviour.
Yeah, and I do think it's a little curious as well that we say, look, I'm happy to vote people in who can send us off to war, but I don't want anyone in there who might spend too much money on, other things. And he's like saying, well, if we're going to trust these guys to run the country, then maybe we should trust them with our financial system as well. And if you don't, then maybe we need to.
I don't buy into a lot of this fear talk anyway, because first of all, in my experience talking to politicians, they are terrified of inflation. Australian politicians for years have been terrified of being accused of introducing policies that are inflationary, particularly, the Labour Party go for an election. That's the worst thing they want to be accused of, that any of their policies would be irresponsible in any way and inflationary. The right way to budget, once you understand modern monetary theory, is to make sure that you have a very well-resourced and highly skilled parliamentary budget office. And that parliamentary budget office is independent of the Treasury, as it is at the moment, and independent of political influence. And it should have the same sort of status as the Reserve Bank of Australia has. And then the Parliamentary Budget Office every year is expected to, well, at the moment, they look at the government's budget proposals and they assess the implications of those budget proposals for the fiscal balance in the years to come. But actually, they've got the wrong focus. What they should be doing is they should be turning themselves into the best inflation forecasters in Australia, or hiring the best inflation forecasters in Australia. And it should be the job of the Parliamentary Budget Office every year when the budget comes out and before an election for both the government and the opposition to look very carefully at fiscal programs and forecast over the next few years the potential for those programs to contribute to inflation risk.
Yeah.
Go on.
Now, I've got to push back a little bit on this one, because we've got the RBA, who's in theory, been doing inflation forecasting, and they've got quite a big staff there. So I'm assuming that's what they're spending most of their money on, and they've effectively starting to give up now on inflation forecasts, and have been terribly wrong with them for the last few years. So I guess what I'm trying to go with is, do you think what do you think we're doing wrong with the inflation? Well, what's the RBA been doing wrong with their inflation forecasting that could be done right in a new organisation, or is it just that I guess they've got their economics sort of we're still using yesterday's economics to try and describe today's economy?
Absolutely. When it comes to forecasting inflation, the emphasis should be on getting down and dirty with the data, really looking at the microeconomics of it. So if you're interested in the consumer price index, then you ought to be looking at the main components of the consumer price index. So housing and energy and transport and education and healthcare, and of course there's discretionary consumer spending as well, all the main elements. And you need to be looking at what you were talking about before. I don't think there's been enough emphasis on this in recent years. What's the spare capacity in these sectors of the economy? How much spare capacity is there out there at the moment? And then on top of that, you need to be looking at monopoly, because you can see inflation pick up because of excess demand in various sectors of the economy. You can also see inflation pick up as a result of monopoly power. And then when you're looking at budgeting for the years ahead, if it looks as though the direct and indirect consequence of the government's plans will push part of the economy towards or beyond its capacity in a way which is inflationary, then you've either got to look for pay-fors to deal with that, and that could sometimes involve taxation, but that doesn't mean taxes are literally paying for government spending. Or you've got to look at ways of expanding that, planning for and expanding that capacity and prioritising and timing government spending so as to not push those sectors of the economy beyond their capacity. And where monopoly power is an issue, then you've got to look at competition policy and sometimes at regulation and how that monopoly power is being exercised, and to try and deal with that. So competition, productivity, spare capacity, those are the important issues. What the RBA has got wrong for years is that for decades now, we've had this view of the economy where it's been assumed, really, without very much empirical evidence, that you can use monetary policy in order not only to put downward pressure on inflation. They could certainly do that by creating a financial crisis if they wanted to, by jacking interest rates up. But you can use monetary policy when inflation is below the level which is desirable, when unemployment is above where you'd like it to be, to push the economy forward. And it turns out that interest rate cuts after decades of rising private sector debt, especially household debt, don't work anymore. I've got into trouble with famous economists like Stephen Koukoulas for saying this repeatedly recently. They think I'm an idiot, but interest rate cuts put upward pressure on asset prices. So if you push interest rates down to zero, don't be surprised if the stock market goes through the roof, and don't be surprised if property prices go up. I mean, that's just basic financial mathematics. You have interest rates on the bottom when you do present value formulas. But if you're trying to get people to spend more, interest rate cuts, they redistribute resources. Sure, some people have more disposable funds when interest rates are lowered, but other people have less. People who are relying on term deposits, etc. The government pays less in interest on its existing debt over time as that debt rolls over when interest rates fall. So that's deflationary as well. And people who borrow more now because interest rates are lower, that's just a sugar hit. Next year, they're going to have more debt that they'll have to start repaying. And it's actually going to constrain spending in the future. Monetary policy doesn't add to the net financial assets of the private sector. Monetary policy can only act as a sugar hit when you're pushing the economy forward. Go back to the early 1990s when interest rates are very high and there's very little private debt. And when you cut interest rates, you'll stimulate spending in the economy. Come forward to 2020 and cut interest rates, and you'll help to prop up asset markets, but you're not going to do very much to push the economy forward. And so what I've been saying for years is that the Reserve Bank has no bullets.
Inflationary expectations. So that's this sort of, I think there's been a bit more pop up, over the last little while, and I think even the Fed was mentioning a bit about how to, some thoughts on that. I guess there's this view around that if we're doing sort of not official MMT, but it's sort of quasi MMT, where the government issues whatever government spends $1 billion. They then issue their bonds to soak it up, but the central bank buys all those bonds anyway. So, which is, I guess from my perspective, and I think from yours, indistinguishably different from just spending the $1 billion. But there's an expectation that if they just go out and spend the $1 billion, that's inflationary, as opposed to the sterilization, so to speak, by passing it from one pocket to the other pocket. Have you got any thoughts on that?
It's the spending which is potentially inflationary. The funding of it really isn't. When you auction Treasury bonds, you are swapping, effectively you're swapping exchange settlement reserves, which under normal circumstances are a highly liquid interest-bearing financial liability of the general government sector for Treasury bonds, which, given the secondary market for them, are a highly liquid, interest-bearing financial liability of the general government sector. So why you would think that bond issuance significantly reduces the inflationary risk of government spending, I don't know. And then when you do quantitative easing, or you get the central bank to do quantitative easing, of course, they're buying those government bonds back again. Well, that's not going to be an inflationary thing to do, except for the fact that it will have an impact on long-term interest rates and yields, and potentially on financial markets like the stock market. It's not going to be inflationary more generally. Why would it be? The private sector ends up with interest-bearing balances at the RBA, albeit that interest rate is basically zero now. And the private sector no longer owns those interest-bearing Treasury bonds. If anything, it could be mildly deflationary in the long run, because the government is no longer paying interest to the private sector on those bonds. Sure, the ridiculous way we've set up the system, the government pays, in inverted commas, interest to the RBA, which means that the official public account of the RBA is debited by those interest payments. Those interest payments are then part of the Reserve Bank's profits for the year. They are then paid back to the Treasury in dividends. So it's just all unnecessarily complicated. And I think when Philip Lowe says, oh, we need to do things this way, rather than just buying the Treasury bonds directly from the government or giving the government a permanent overdraft at the RBA, I don't. He talks about credibility and inflation expectations, but I don't. To be honest, I don't think he believes what he's saying. He's never entirely credible, and he's usually very credible. He's a brilliant man, usually very credible when he's talking about monetary policy. But once they start talking about QE and distinguishing between QE and just simply buying the Treasury bonds in the primary market, which is what happens in Canada to an extent, and in a variety of countries, in Indonesia this year, for example, then I don't think he's very credible. I really don't see what the difference is, as far as balance sheets are concerned, between the Australian Office of Financial Management auctioning Treasury bonds, financial institutions buying those bonds, and then financial institutions selling those bonds to the RBA. So you end up with the RBA holding the Treasury bonds, and the government has had dollars credited to its spreadsheet cell, its account.
And the financial institutions have also had some dollars credited to their accounts from.
They make a profit as the middleman.
Yeah, that's right.
That's how it works.
That's why you're not hearing complaints. Yeah.
I know what they like it, but I don't really see. You end up with the Reserve Bank holding the bonds anyway. So it would be no different to if the Reserve Bank just took the bonds in the first place as non-marketable Treasury securities that the Reserve Bank held on to, which the Fed has been doing that a little bit this year as part of its stimulus measures. Perhaps I won't go into that now, but it's unnecessarily complicated. The whole system is unnecessarily complicated. All Treasury bonds are transferable. Sorry, go on.
I guess what I'm getting to is if inflation expectations, and there's a bit of research out now, just sort of basically saying, well, maybe it's inflationary expectations that we need to, because all these the Phillips curve isn't working anymore, and all these other factors we thought weren't working anymore. So maybe it's inflationary expectations, and which is a pretty good argument for flipping to MMT, because if inflationary expectations stay low while reserve banks and Treasury play this game of cups where they're just passing the P between them, then maybe just the the branding, so to speak, of MMT might increase inflationary expectations, which might actually then lead to more positive inflation.
I do have a tip for people, which is if they want a Phillips curve that works, then they just need to eliminate the unemployment rate from the horizontal axis and put the underutilization rate there. Because actually you do get a Phillips curve shape with a reasonable fit in Australia in recent decades if you just put underutilization there and just reflect the fact that our official unemployment statistic has much less meaning than it once did.
Yes.
So we do not believe that it makes sense to try to get to full employment. And when I talk about full employment, I don't mean the so-called non-accelerating inflation rate of unemployment that the RBA or the Treasury might talk about. I mean 1960s style full employment, 1% unemployment. We don't think you can get to a 1 to 2% underutilization rate instead of nearly 20% where it's been recently by just engaging in deficit spending right the way across the economy to get you there. Because of course you come up against bottlenecks. The people who benefit from that deficit spending are not the people that needed the help in the first place. Yes, you come up against capacity utilization issues. You run out of skilled labor and inflation picks up. Of course it does, before you get to a situation where you've basically eliminated involuntary unemployment. And that's why the one perhaps distinctive policy proposal that comes from modern monetary theory economists, that to an extent you can divorce from modern monetary theory because it's not part of the description of the monetary system, but it is something that we think would be a good idea as a better mousetrap, a better automatic fiscal stabilizer in our economy, is the introduction of a federal job guarantee. We would like to remove the buffer stock of unemployed workers, which is the approach that we've used to try and manage inflation in Australia and in other countries around the world for 40, 45 years now. We'd like to replace that with a buffer stock of employed workers. We'd like everybody to have the opportunity, if they're not in full-time employment, to be employed in a range of activities which would be managed locally, reflecting local social environmental needs, but funded federally. Should they become unemployed or be unable to get full-time employment, it's important that if you're in a job guarantee, you're being paid at least at the legal minimum wage, you're having decent working conditions, you have superannuation, you have leave, you have all that kind of stuff.
Sorry to jump in.
Go on.
I just want to focus us a little bit back more to the investment side, and I guess
absolutely.
So I have sympathy for your role, and I'd love to see it, particularly in research and development. Love to see that, but I guess what I'm interested is governments globally that you think are the closest to sort of accepting MMT.
Just before we kick off that one, actually, I had a question here bubbling away in the background that I might just pose to you to sort of set the scene a little bit as well. Just drawing on your full monetary sovereignty line that you used there, which I think, and correct me if I'm wrong, the three tenets were freedom to create currency, free floating currency or an unpegged currency, and then no to little foreign debt. Stephen.
Yeah. No to little foreign currency denominated debt.
Foreign currency. Perfect. For mine, that doesn't leave a lot of countries that can use MMT. Would I be correct in saying that?
Well, if we're talking about full monetary sovereignty is a continuum. So as I was saying before, we're bound to oversimplify a little bit when we discuss these things. But at one end of the continuum, sure, is the USA. But there are quite a number of countries that are close enough to the US on the continuum to be regarded as full monetary sovereign economies. So that would include Australia and New Zealand and Japan and Canada and the UK and some other countries as well, predominantly very high income countries. Obviously, the Eurozone countries are not themselves fully monetary sovereign, because the currency issuer in the Eurozone is the European Central Bank. There is no European federal government at the top of the European monetary system, so they're in a different position. Incidentally, one of my graduate students has just done some very detailed statistical research, which the results of which we'll publish before very long, which proves that if you are a monetary sovereign like Australia, you can ignore the credit rating agencies as far as the yield on government debt is concerned. Standard & Poor's and Moody's have absolutely no influence on the interest rate on Australian Commonwealth government debt. That's true of those other monetary sovereign economies too. It's not true of non-monetary sovereigns. They're in a completely different case. That doesn't mean that MMT has nothing to say about them, because modern monetary theory is not just about monetary sovereign governments. It is about certainly the fiscal space that you lose, what you're giving up when you give up your monetary sovereignty, for example, joining a currency area like the euro. And MMT economists were amongst the clearest people warning about the fact that the Eurozone was not well designed before it was introduced. And also about how, if you don't have monetary sovereignty at the moment because you're an emerging economy, how you can build additional fiscal space for yourself, how you can build monetary sovereignty over time, including thinking about issues like energy sovereignty. A lot of economies in the next few years, and actually there are plenty of them that have got quite a way already with this, are well positioned in terms of developing local renewable energy and reducing their dependence on imported fossil fuels. That reduces the threat of a currency depreciation. If you are not fixing your currency or not managing your currency as heavily in the future as you have done in the past. It's also important in a lot of countries to look at issues like food sovereignty as well, because one of the reasons why governments around the world are so scared of having a floating exchange rate is the risk that depreciation will increase the cost of imported basic necessities that are priced in foreign currency, that will increase the cost of living of people who are already on the edge of subsistence, and spread poverty and undermine social stability. So we're focusing a lot on those kind of issues, but it's never going to be the case that lower income countries have the same sort of fiscal space that the US does. So then you need to look at issues in international finance, like net financial flows, how we've organized our global financial system. And isn't it strange that lower income countries have not been the net recipients of financial flows in recent years? Instead, finance has gone in the other direction. It's gone from poor countries to rich countries, as poor countries' financial positions have been eroded over time. Interest payments on debt that they took out in previous years, obviously in foreign currency, they can't borrow in their own currency, and funds being repatriated by foreign multinationals. That you need to look, in other words, strategically, and any particular country at how much fiscal space does the government have in order to pursue policies which will enhance the productive capacity of the economy and be in the public good in the years to come. Where you don't have a high degree of monetary sovereignty, how can you build that monetary sovereignty? And where there are governments that have, for one reason or another, got large foreign currency denominated liabilities, then we need to look as a world, if we want, particularly if we want them to make the kind of investments which are going to build economies which are generally sustainable and that will help us to live within 1.5 or 2 degrees global warming and all that. That's where you start looking at global finance. and at the kind of support that high-income countries in the years to come in terms of the provision of hard currencies and your technological exports, that sort of thing. We need to look at all those issues again. It means going back and looking at trade deals. But yes, MMT economists are very, very active in these areas because modern monetary theory is not just about full monetary sovereigns. It just so happens that in Australia, we are fortunate that we are a full monetary sovereign. There's plenty of foreign investors that own Australian government bonds, but the repayments on those bonds are in our own currency. That's the important thing.
Yeah, sure.
Yeah. So Stephen, coming back to which countries are closest?
Well, it depends what you mean by which countries are closest. The full monetary sovereigns are the USA and Canada and Japan.
Sorry, I'm asking where you think that modern monetary theory is making some inroads into policy decisions, as opposed to being cast out as an unwanted intruder on traditional economic thinking.
I think we are making inroads into policy decisions everywhere. That doesn't necessarily mean that you are going to get the governor of the Japanese central bank saying that kind of thing in public, but we are making inroads everywhere, even in Australia. MMT is having more influence now. We've got past the point where we were being ignored. We've got past the point where we were being laughed at. We have got to the point now where in academia, there are a lot of people who are very upset and offended because we are questioning some of the things they've held dear for a long time. But where increasingly in finance and also amongst government economists, if not politicians themselves, people are listening and they're engaging. I've done a couple of webinars with ANZ over the last year. I've done a talk, and I'm a minor player. I've done a talk at the Department of Prime Minister and Cabinet in Canberra. People are listening because policy economists and people working in financial institutions too, well, policy economists just want to understand the world better. They want a better set of tools. And if you can convince them that they ought to at least be aware of what you're discussing, then they'll listen.
And I think market economists are happy to say, look, we can see things aren't working. What are the other options out there? What else should we be thinking about? It's more the people, I guess, who have the ear of governments. And so, obviously, Stephanie Kelton was Bernie Sanders' economic advisor, but I don't think any of that seeped into the Biden administration.
Well, it depends what you mean by seeped in. People have maybe people have short memories. Even in Australia, last year, if you were to look at the budget papers, it would tell you that the government's strategy was to run a fiscal surplus on average over the economic cycle. Yep. Not that any government has ever done that in Australia, except the Howard government since Federation, really. But that's what, for years, they've said their fiscal strategy is. Now, I don't know whether they'll even put that in the next set of budget papers, but it's going to look pretty ridiculous because everybody knows that's not going to happen.
We're not going to run a
people are understanding other things too. Now, I'll just give you one other concrete thing that I've found policymakers and some politicians as well, quietly interested in thinking about. When the pandemic struck in March this year, the government announced basically that it was prepared to do $200 billion of deficit spending. Now, the old story is the government would go and borrow $200 billion in order to be able to spend it. The only way that you can pay for Treasury bonds in Australia is to either directly or indirectly use exchange settlement reserves that the private banks have at the RBA. That's what pays for Treasury bonds when they're issued. there were about $35 billion worth of such reserves in existence in March this year, when the government announced $200 billion worth of deficit spending. Now, once I explain that to people, they think, oh, well, how's that work then? And then you explain, well, that's because the government actually has to spend the dollars into the system, or, and there's been a lot of this, the Reserve Bank has to put the dollars into the system itself by lending or by buying financial assets before those dollars are available to buy the Treasury bond. It's that way around. The old story that you have to tax and borrow before you spend is clearly shown to be wrong. You actually have to spend the dollars into the system before you can tax or borrow those dollars back out of the system again. That's the way the monetary system works. It's just factual. And the most powerful thing that I usually find myself saying, if I'm talking to politicians or their advisors or other economists, is what I've just said is just pure fact. There's nothing you can disagree with me on. But when you understand it, it just changes the way you think about government finance.
The question there, I guess, Stephen, though, is, and I guess, you know, we're very good, and I guess as a population, or maybe looking locally at the RBA sort of dictating whether or not the economy's running hot or needs needs some help vis-a-vis the monthly meeting outcome on the rates. The question for mine, and I think you're right with the taxation being effectively a demand drag, if you will, or a stimulatory measure. But the problem is that we can't just announce it on a monthly basis that everyone's going to need to, the tax rates are going up by 0.5% or down by 0.5%. Is that a limiting factor in, I guess, implementing what is otherwise a pretty easy to understand component of MMT?
I don't think so. I'm quite comfortable with the RBA being independent in terms of setting interest rates. If people like the system, we can keep it. It doesn't do any harm. But I can tell you what's going to happen to interest rates over the next few years, which is nothing, or nothing much. Because any significant increase in interest rates, there's still enough fragility out there in the financial system would just make things crash.
And leverage.
Put interest rates up a lot, and they can't put them down. Yep. So we may as well forget the RBA. There isn't anything they can do, really. Even quantitative easing doesn't do that much. If you're worried about it putting upward pressure on the stock market, then APRA could do something about that with a bit of legislation behind them. You could ban borrowing secured on financial assets. Or secured on certain. There's lots of things you could do if you wanted to limit upward pressure on the stock market, if you thought that was an important thing to do. But low interest rates, we've got them forever. Yep. I actually don't think it's been a good thing in the past when they have changed interest rates every month. So far from it being a disadvantage, I think it's an advantage. I don't want them changing stuff every month. But that's where, and not to go back to the job guarantee again, that's where what we need is more effective, automatic fiscal stabilisers.
And so
sorry, go on.
I was just going to say, so then pivoting across from the RBA to the tax side, though, you haven't quite got that, that resolution on being able to alter tax rates, in reference to, stimulating or supporting the economy. As a population, the government of the day can't decide that, we're going to try and control inflation or stimulate the economy by, although, I guess there's an argument this year where we have had some tax cuts. But, raising tax rates is a very difficult political challenge, even though, it is a good demand, remover from the economy and in slowing it down. So.
Well, you don't necessarily have to do that. When we say that taxation is important to limit inflationary pressures, that's not the same thing as saying that if you're worried about inflationary pressures, you need to raise taxes. There are lots of potential pay-fors out there. Potentially, if you thought it was useful, you could increase interest rates. I think that macroprudential regulation is more useful. Actually, myself, as far as limiting inflationary pressure on that side. But on the other side, there are all those issues that I was talking about before. When you're thinking about the inflationary consequences of what you're doing, you need to look at issues like productive capacity and whether it exists or whether you can create it. If you are thinking about big government investments in the economy, then if inflationary, if you believe that they're going to be inflationary, you may have to limit actually going ahead and doing them in the first place. It may be that you may raise taxes. When people say it's incredibly difficult to raise taxes, that's because of let's use the word, that's because of a neoliberal campaign going back over 40 years. It didn't used to be. Australia had a far more progressive tax system, incredibly more progressive tax system in the 1950s and 60s and 70s, even the 1980s, than it does now. So that's a modern phenomenon. It's not necessarily going to change. There are other things you could do as well. You could vary contributions into superannuation while you've got a super system, based on if you thought that it was necessary in a Green New Deal, say, to make big public sector investments, you worried about that being inflationary, you could lock up people's savings for a while.
Interesting one.
There are lots of things you could do. Raising taxes is just one of them. That doesn't mean that I think that it's impossible to raise taxes. And if it has become so because of the game of mates that we've had in Australia, because of all the grey corruption that's built up and the enormous political influence from lobby groups, then that's a separate issue that needs addressing in the next generation.
Very good. Thanks for that.
Questions, Tim?
Yeah, sure. Look, there was one here that popped out before we were sort of talking around inflation. That there's a comment from commenter David. RBA just needs to put housing prices back into inflation data, and they'll hit their targets, and then we can put the rates up again. You're talking about automatic stabilisers. That's probably an interesting approach. Thoughts on that one, Stephen?
Well, I suppose so, but the statisticians argue that in what the consumer price index is supposed to measure, that the house prices they're not part of what should be in the consumer price index. Housing costs are in the consumer price index, but if you cut interest rates down to zero, then that is going to put upward pressure on asset prices. We are seeing and continue to see, and of course in Australia, we've got another distortion, a political distortion. Whoever is in the government, they are absolutely terrified here, much more than they are about the country burning down or anything. They are terrified of a property price crash. So there is nothing it's like the Greenspan put in the US with monetary policy around the year 2000. If the stock market fell, they'd cut interest rates. Well, in Australia, if there's any signs of the property market imploding, the government will do absolutely anything. It doesn't mean that a time might not come at some point in the future where there's some sort of Minsky moment where whatever the government does might not be enough. But they'll do virtually anything to prop up the property market. And on top of that, we've got as close to zero interest rates as it would be wise for us to have.
Well, actually, that's both of those come into an interesting question, Stephen, on the TFF, which I think somebody was asking there as well. And I better just for listeners, let me just put this into a little bit of perspective. And we've spoken about it a few times on here. So the term funding facility is effectively the Reserve Bank saying, well, interest rates have hit zero for our overnight rate, but what we're going to do instead is we're going to create a three-year facility, and we're actually going to lend directly to the banks, provided that they then give it to businesses or homeowners. And at the moment it's 0.1%, I think, in Australia. So basically, the RBA will lend to banks cheaper than what a state government can borrow, if they'll go out and put it into home loans. And that's why you're seeing such cheap rates on 3-year rates, and usually cheaper than overnight. And the effect in Australia has been to drive interest rates below 2%. In Europe, they've got the same system, and they're now up to paying 1% to anyone who will lend. And so effectively what happens is if you take out a loan in France or Germany and you pay 0.5% in interest, and then the central bank will go and top up that by another 1% to basically double your whatever you paid in interest and give that to the bank in order to try and get lending up there.
It's
And
not
so
a wise thing to do, is it?
It's
we know why they've done it. As far as the term funding facility is concerned here, that's a little bit of a byproduct of rules relating to bank liquidity, net stable funding ratio rules, they're called, which were implemented around the world after the global financial crisis, when there were liquidity rules introduced which didn't exist before, which means that banks cannot rely just on overnight funds or on overnight and money market funds in order to fund the liability side of their balance sheet. So it put more pressure on banks to compete more aggressively for deposits, but also to borrow longer term. So although money market rates are very low, what the RBA is doing is allowing the banks to meet their net stable funding ratio requirements at those very low interest rates too. That's basically what that facility was about. The facility, I don't think, has stimulated any significant increase in lending by the banks. On the other hand, it has reduced their funding costs marginally. And initially, when it was introduced, the take-up was quite slow as well. So I don't think it's all that important. I think it's more it's more to do with the regulatory rules under the Bank for International Settlements rules, or the Basel rules, as they're sometimes called, and just meeting those rules than anything else. But yeah, we've got virtually zero interest rates, even quite far across the yield curve now, and default risk-free interest rates. And as far as the cash rate is concerned, it doesn't really exist anymore. There is hardly any overnight lending happening in the banking system because of quantitative easing. And with the RBA doing another $100 billion of it over the next few months, then that's going to continue to be the case. If you go on the RBA site and you look at the spreadsheet where they give you the cash rate, it's not 0.1%, the so-called target cash rate. What they usually say is each day at the moment is 0.05%. But even then, there have been a lot of days in the last few months when you look at the number of overnight transactions, it just says not available or not applicable, because there basically haven't been any. And so when they tell you what the cash rate is, it's just, well, there was some overnight lending 2 or 3 days ago. We'll say that's the cash rate. There isn't a cash market at the moment. There is no overnight cash market. And the cash rate that we still pretend the Reserve Bank is targeting doesn't exist.
Interesting.
That's where we've got to, and a lot of that is because we've been looking to the Reserve Bank to do things that the Reserve Bank is not equipped to do. If you want to push demand forward and bring about a recovery, then you need the government, far from cutting back on support they've introduced, they need to be maintaining that support for longer, and perhaps running an even bigger fiscal deficit across this financial year than they would otherwise have done. The more
or as we discussed, to score a better targeted one.
Yeah, better targeted as well, but also we do need, however you do it, and one way of doing this would be a more progressive tax system, but I, as I said, would be in favour of, I would have phased out JobKeeper and replaced it with a job guarantee. We need a better automatic fiscal stabilizer, so that when the economy needs it, the deficit automatically gets bigger. When the economy doesn't need it, it shrinks.
Yeah, and we didn't even talk about that in terms of the pointing the budget in the wrong direction. We've done exactly the opposite of what you wanted, though. We've cut the tax rates on the highest people and reduced the JobSeeker and JobKeeper. or started to phase it out.
Yeah, well, there you go. That's part of our narrative that we've had for inequality has been rising in Australia more or less continuously since 1975. At some point, again, not to come over as a lefty, but at some point, we have to address these issues because, I mean, if we keep going in this direction, you are inevitably basing the prosperity of the economy on iron ore prices and the willingness of households to go further and further and further into debt. And that's not a sustainable thing to do in the long run.
Well,
it led us to zero interest rates. Inevitably, we were going to get to zero interest rates, not just in Australia, but in other countries too. If you keep cutting interest rates to encourage people to go further and further into debt, and in other countries, it's often businesses that have been going further and further into debt, then that sugar hit, you can do it again and again and again, but it's going to mean interest rates get cut and cut and cut again, and you are inevitably on a path to zero interest rates when it won't work anymore. I don't think negative interest rates are effective. At that point, you have to turn around and think, well, there's been something wrong with what we've been doing, or maybe it could work for a while because of the set of balance sheets that existed in the early 1990s, having a situation where fiscal policy was supposed to be neutral and the central bank was supposed to run the economy by nudging interest rates up or down, more often down than up. Maybe it worked in 1993, but balance sheets have changed and it's not going to work now. So we need to turn around and think about another approach. And whereas modern monetary theory is not a specific approach to managing the economy, it's just a lens. So in a way, when people say, where has MMT been introduced? I almost don't know what to say in answer. I don't want politicians to talk about modern monetary theory. I don't want them to mention it in the budget speech. I just want them to make decisions based on an understanding of it. They don't ever have to mention it. But once you understand that there is a difference between the currency issuer and currency users, and we've been running our economy by encouraging currency users to go further and further and further into debt, and you end up risking what we sometimes call Minskian financial instability when you do that. If there was a major downturn, if we hadn't had big fiscal support in Australia this year, the property market would have crashed and there would have been a tidal wave of defaults and a major depression. So what stopped us doing that? Well, what stopped us doing that is the government turned around, having said they couldn't afford to run deficits and how important it was to run a surplus, and suddenly they ran a huge deficit. So well done, government. The only thing I would have given them at least 5 out of 10 for their response in March. I wouldn't have used the same measures as them, but it was good that they were prepared to act on a reasonably big scale and to act quickly. The biggest argument I had with Josh Frydenberg at the time is when he said it's because of our fiscal responsibility in the last few years that we've been in a position to do this. That is, from an MMT perspective, utter and complete nonsense. The Japanese government has 6 times as much debt as the Australian government. The Japanese government was no less able to support its economy using its budget than the Australian one. Understanding that when you don't face an inflation constraint at the moment, that you have no purely financial constraint, it's a really important insight. It's a very simple one, but it's a really important insight. It's neither left-wing nor right-wing. It's something that Josh Frydenberg could benefit from understanding in the years to come.
But the Minsky moment, that's, I think you sort of touched on something that's near and dear to my heart as well, though, is that, as you said, his whole thing is that stability breeds instability eventually, because for everyone who's out there rushing to get a loan and gear up now to take advantage of the lower interest rates, it's the thought that it's the more and more debt you pile on, and so that just means the next crisis we go into there, instead of with 120%, debt to GDP, household debt to GDP, we go in there with 150 or 160 or 200. And if we get bailed out again, then you just got to pile on more and more money, and you sort of end up in this whole the part about if you know the government's got your back, then you may as well just get as much debt as possible until one day they actually say, well, you know what, we can't afford to keep letting the people who have geared the most win the most out of this. We actually need to let some people fail and capitalism resume. But I don't think
that's the sort of Austrian approach. But that's you see, I'm not attracted to that.
No, I'm not saying
looking at it, because it's like saying, let's not have fire engines, let's have no fireys when a fire breaks out, because actually you should have been much more careful in the first place. So what I think you need regulation, and I think we did have, and Minsky wrote about this too, financial systems, they often call it financial suppression or financial repression, not being allowed to do things, or having financial institutions that are limited in the range of activities they're allowed to engage in. But actually, it worked pretty well. Throughout the history of capitalism, there have been regular banking crises every 10 years or so prior to the Second World War. And then, of course, in recent decades, we've had close to financial crises or financial crises in the 80s and 90s. And then we got the global financial crisis and all that. But there really weren't any between 1945 and the 80s to speak of. And the reason for that was we had a fairly tightly regulated financial system. And you wouldn't have the same regulations now, but we can go back to that again. APRA had moved a little bit in the right direction 3 or 4 years ago. They were tightening up on investment mortgages. They were tightening up on interest-only mortgages, amongst other things. In the last year or year and a half, I think, they've reversed again. So they've sort of relaxed the rules entries. It's a big mistake.
Yeah, but I guess what I'm saying is, if there's no penalty for making a mistake and having too much debt when the economy goes into a downturn, then doesn't it just mean for everyone you just gear up as much as you can? Like I'm not arguing a full Austrian. Okay, everyone has to take the losses, and we'll all get better eventually. But I do think there's an element of saying, well, if nobody takes a loss, then all that happens is speculation becomes rife. And
absolutely, I think if you personally make unwise decisions, or your institution does, definitely you should lose out as a result of that. I think if banks have to be rescued following a crisis, then the shareholders of those banks should lose.
Yes,
but that doesn't mean the bank should be allowed to fail.
No, absolutely.
But we can't. I mean, this is if you're not careful, you can end up going quite far towards a left-wing view of the world. I see our commercial bankers, anyway, as basically public servants. They are basically public servants because they are working for institutions, the Commonwealth Bank, the ANZ, Westpac, NAB, which will never, ever be allowed to become insolvent.
Oh, well, and now they're funded.
They're too important in our monetary system. Their jobs are safer than working for a state government in some ways. And they're never going to be, they're far too big and powerful to fail. Now, how are you going to go about changing this? You need to start talking about, as Bernie Sanders does, about if a bank's too big to fail, it's too big to exist. And that means you then need to say, well, we don't actually have massive economies of scale in banking. Not anymore. We don't actually need massive banks. So what about limiting the size and scope of private financial institutions in Australia? Or there are all sorts of other options that you could take as well. I'm not saying you should necessarily do that, but I am saying that it is something that it would be interesting for people to think about a little bit more. Why do we need such large financial institutions, which is so very powerful? The state government in South Australia tried to raise a little bit of tax because our state government is not a currency issuer, by taxing the banks, and yet the flack they took from it, they had to back down almost straight away. These institutions are enormously powerful and influential. Even after the Banking Royal Commission, really not very much has happened because they're so powerful. Now, maybe we need them to be so powerful, but maybe we don't. If we are going to have institutions which are this large and too big to fail, and if we are going to have a property market that's so inflated that its collapse would be utterly catastrophic for the economy as a whole, then we need to look very carefully at how we're regulating these institutions and their behavior insofar as it impacts on that market, and whether we're doing it effectively or not, which I think part of the outcome of the Banking Royal Commission was, no, we're not. But I'm not clear that anything very fundamental has changed. So yes, but I agree with you. People should be able to make losses, and businesses should be able to make losses. But unfortunately, we have a system where there are certain institutions that cannot be allowed to fail, and we have a market which, if it crashed, would be utterly catastrophic as far as the economy is concerned. So we need to maybe step back and look at how we think about that market and housing in general, and housing affordability and mortgages, and how are these things done in other countries, because not all other countries have the same approach we do. And as far as those private institutions are concerned, do we need a government bank? The Commonwealth Bank used to be in the government.
Okay, I think we could spend the rest of the afternoon on this one.
Sounds like a whole nother topic. Whole nother topic. Back on, really. Stephen.
But I agree with you fundamentally. We have a financial system which would have crashed had the government not acted very aggressively with fiscal policy this year. The quantitative easing helps a bit, of course, because it holds up financial markets as well, and the property market. But yes, in the medium-term future, our financial system and the level of private debt, especially household debt, is still a problem that needs addressing.
Absolutely. That's a great note to finish on as well, Stephen. Thanks very much for that.
No problem.
We've got now we have gone a bit over time, and I'm mindful of your time. We can jump into the investment implications now if you've got a few more moments, and then we can sort of finish up the show.
Yeah, absolutely.
Lovely. All right, I'll hand over to Damien just for a run through on your thoughts with the investment implications as well, Damien.
Yeah, look. So I've got this long list up there of positives and negatives that we spoke about over the last few weeks, and I think we're certainly of the view that the negative ones are the positive ones tend to be shorter term issues, and that we do have these factors that could cause significant problems if and when we decide to actually start looking at bankruptcies and mortgage repayment holidays and evictions and things like that, which are all sort of coming up. But the flip side is pretty much every country that's ever had one of these pop up has extended the date, and we think that's probably going to be the case again in Australia and the US and other countries. And so the negative factors, provided that the virus hasn't sort of the virus increasing in intensity in northern hemisphere hasn't sort of driven the markets down as of yet. It does seem to point to the fact that we've got a 3-6 month period where the markets are pretty much going to ignore earnings and valuation, and we're going to see, I guess, any negative effects aren't going to come to account because they'll just get extended, and the positive events of there's lots of cover for governments to spend lots of money, as we've sort of seen in state budgets here recently, and we're seeing right around the globe is that there's lots of cover for governments to spend lots of money. So it's not a capitalist position where we find ourselves in, and I guess what we're positing is we've got a fair bit of exposure to equity markets now, a lot more than we had a couple of weeks ago, and it's a matter of looking for policy mistakes really in terms of the investment side, because everything's being run from either central banks or federal governments, and so policy mistakes are the things to watch out for.
Very good. Anything else to note on that one? I think that's happy to cover off there, finish up there, fellas.
Yeah, finish up there.
I think we have gone very over time. Well, look, there. Thank you, Stephen, for your wonderful thoughts and plenty of your time as well, your precious time. And I just thought I might quickly offer to our audience just ways that they can follow some of your work and track what you're up to.
Well, thanks very much. Yeah, we will probably in March next year. We'll be launching a new think tank called Modern Money Lab. That is not up and running yet. It's going to be for the finance sector and funded by some individuals in the finance sector.
Terrific.
I have a campaign group at the moment, which is about modern monetary theory and other things, called the Sustainable Prosperity Action Group, which has a website, which is not difficult to find if people want to Google it. Other than that, if you're interested in learning more about modern monetary theory, I recommend the website stephaniekelton, or one word.com. And I recommend, if you haven't read it, her New York Times bestseller, The Deficit Myth, which was published in the middle of the year, which is easily the best-selling economics book on any topic this year. And there are lots of videos of Stephanie. There's even a few of me interested, but on the internet if you want to learn more.
Excellent.
I think Stephanie is a very important economist and will be for the next 20 years.
Absolutely. All right. Well, look, yeah, thanks again. We thank you for your time, and we certainly look forward to getting you back on the show. I think we've uncovered a series of topics that almost deserve their own show as well. So we'll tic-tac through and get you on as soon as we can as well, Stephen. Thanks for your time.
Thanks very much. No trouble.
Cheers. And thanks to you, Damien, as well, for another good show.
Thanks, Tim.
All good. Now, the viewer question of the week, actually, and on reflection, I might change this a little bit, but I've got, which country do you think will successfully implement MMT? Now, I think we've covered on the fact that pretty much everyone's already doing it, so maybe it's implement the understanding of MMT and perhaps a universal basic income. Feel free to drop your answers in the chat box in the YouTube video, of course, and we'll look forward to picking through those and chatting around those. So on that note, thanks again to all of those who have watched in live for another great episode. To all those, of course, who've asked questions as well. I hope you've taken away some great ideas. If you'd like to see more of our content, head over to nucleuswealth.com/content to stay up to date on news from us. Follow us on social media. And finally, if you know anyone who gets something out of today's episode, let them know about it, share with a friend, and help our show grow. So thanks again for tuning in from myself, Tim Fuller, and the team, and we look forward to catching you at the next one. Cheers.